Competition Policy Program, and I welcome you to this 17th webinar of the year. And today we'll be discussing the thorny issue of rising fuel prices in the country. I'm glad we are joined by Engineer Edward Kinyua, who is the Director at EPRA, in charge of petroleum and gas, and he'll be giving us the lowdown on the petroleum pricing formula. So as we begin, by way of just context setting, I think for the past few months, and actually maybe for the past year, we have witnessed as a country the rising fuel prices in the country, and that has not gone down well with the majority of Kenyans. Actually, so to speak, let's say just Kenyans in totality. And so we just want to get to understand how the fuel prices are set and what are the metrics that are used, or what are the considerations being considered when setting the fuel prices in the country. So I just want to say a few things before I can allow Engineer Edward Kinyua to give us his presentation. So as we know, the regulation came into place in the year 2010, and I'll not speak more on that because I believe the engineer will give us more on that. But I just want to mention that regulations are meant to benefit Kenyans, or let me say, to benefit individual welfare. The reason why we have regulations is to ensure that the industry does not take advantage of consumers' plight. And why do I say this? When the regulation came into place in 2010, the notion then was that there was some steep rise in fuel prices, and so the government came in to regulate the fuel prices to ensure that consumers, that's you and I, we are not, let me say, we are not taken advantage of by the oil firms that bring in or sell the commodity in the country. And that's why that's the reason why we have the regulations that were passed in 2010, and that's why we have this every other month. We have the EPRA that replaced the defunct ERC to come up with the fuel prices based on a particular formula that was passed in the law and in the regulations that actualize that particular law. So that's one. On the other hand, these regulations come into being to ensure that either there's a price floor, that is the minimum, or a price ceiling, and that's the maximum that can be set. And within that framework, then there's the players within the industry who gain some particular amount that's for them to actually continue being in operation in the market. So without actually trying to delve much into what is and what is not within the regulations and within that particular petroleum pricing framework, I want to just welcome Engineer, if you can hear me, Engineer. Kindly unmute, Engineer Kinyua, please.
Stephen, can you hear me?
Yes, we can hear you. Go ahead.
I hope you can hear me loud and clear. I'm in a place where network is misbehaving a bit, but I hope we'll be able to have a conversation and be able to decipher this issue as you had wished. So my name is Engineer Edward Kinyua. I'm the Director of Petroleum and Gas at EPRA, And if you may allow me, I would wish to project my screen.
Please go ahead.
I hope you can see my screen.
Yes, we can.
Okay, so I can start the presentation. Basically, I'll be discussing about the framework of petroleum pricing in Kenya, the legal framework, and of course, the numbers that go into the pricing and the basis for those numbers. So first is the mandate of the Energy and Petroleum Regulatory Authority. We established under Section 9 of the Energy Act 2019. And our main mandate in this act is to undertake technical and economic regulation of electricity, renewable energy, downstream coal-bed methane, and petroleum sectors. So we also have another act, which is the Petroleum Act number 2 of 2019, which now spells out our mandate in the petroleum subsector from the upstream, the midstream, and to the downstream. Traditionally, we've been doing technical and economic regulation of the mid and downstream as Energy Regulatory Commission, that is prior to 2019. But with the enactment of the Energy Act 2019 in March, we were now transformed into an authority which will now handle the upstream function. The upstream function has been domiciled at the ministry. Previously, it was at the Ministry of Energy and Petroleum, and now it transferred to the Ministry of Petroleum and Mining sometimes in 2018. So part of our functions is to regulate generation, importation, exportation, transmissions, distribution, supply, and use of electrical energy. Of course, we don't have mandate of our nuclear facilities. The reason being this is a very specialized function and it requires another type of regulator. So we do also regulate and supervise upstream petroleum operations as per the current act. And we're also supposed to collect, maintain, and manage petroleum upstream data. The other function we do is development. We coordinate the development of upstream infrastructure. And to do with the mid and downstream, we do regulate the importation, refining, exportation, transportation, storage, and sale of petroleum and petroleum products. Then we're also looking at the aspects of production, conversion, distribution, supply, marketing, and use of renewable energy. We're also looking at other forms of energy, and here basically we are looking at coal-bed methane, the production, the exploration, extraction, production, processing, transportation, storage, exportation, up to the sale of coal-bed methane and other forms of energy. So another key mandate for us is to collect and maintain energy data. So we are collecting both petroleum and energy data. So when I refer to energy here, I refer to the electricity sector when to differentiate it from the petroleum sector. So if we go to today's topic about petroleum pricing, the legal framework for petroleum pricing is anchored well in the previous Energy Act 206, which was transformed to the Petroleum Act number 2 of 2019. And under that act, we have a regulation called Legal Notice number 196 of 2010, which is the Energy Petroleum Pricing Regulations of 2010. And we have an amendment, which is Legal Notice number 26 of 2012. This Legal Notice number 196 is the one that now comprises a pricing formula, which we use to arrive at cap prices for super petrol, diesel, and dual-purpose kerosene. When we talk of cap prices, is that we set a maximum price, so anybody can compete below that maximum cap. And that is why we call it a cap price. The formula mirrors what is the supply chain from the importation, refining, storage, transportation, up to the consumer, where the consumer is buying this product, and this is at the retail level. And it's a complete mirror of what is happening, especially in the international markets. After 1st of September 2013, all the petroleum products we use in this country are imported as refined. 1st of September 2013 is when our Kenya Petroleum Refineries Limited stopped processing crude oil. So we are now reliant on completely refined products coming from the Middle East, sometimes from Europe, as far as going to the Far East of India. So EPRA has the oversight on the efficiency and standards of the supply chain to avoid monopolistic kind of tendencies, and also to make sure that the consumers are protected from non or substandard products. So this is a value chain of petroleum in Kenya. So we import these products as refined, and for this presentation, I'll limit my products to super petrol, diesel, and dual-purpose kerosene. Dual-purpose kerosene constitutes what is Jet A1 and what is eliminating kerosene. The product is usually one. It comes from the refinery as a one product called DPK, or dual-purpose kerosene. The specifications are similar. It's only that at the point of use now, you can segregate what goes to jet turbines and what goes to kerosene. The one that you segregate for jet turbines, then we put some additive, some anti-static additive, and of course we store it into some special storage tanks with proper filters, filtration system to avoid ingress of water and dust. So once this product is imported, we have two main jetties. We have SOT, it's a Shimanzi Oil Terminal. This is a terminal that is a shallow one. The draft is shallower, so it is only accommodating vessels of up to 35,000 deadweight tons. The Kipevu Oil Terminal is the bigger jetty, which is the main one, and this jetty is accommodating vessels of up to 100,000 deadweight tons. So once this product comes, they are either stored at oil marketing companies' depot in Mombasa. So the SOT is piping this product to the tanks of oil marketing companies, and the KOT jetty is piping this product to Kipevu Oil Storage Facility. That's what we call KOSF and KPRL. KPRL is the Kenya Petroleum Refineries Limited, which was previously doing refining. Now those tanks are being used for storage. KPC has taken it over because the tanks are still in good shape. The only part that was stopped was the refining part. And then from the Mombasa now, these products can either enter the pipeline. We have two pipelines from Mombasa. We have line 5, which was commissioned last year, but to 2, that's 2018, is a 20-inch pipeline, 450 kilometers long. And we have its predecessor, which is a 14-inch pipeline, which was commissioned sometimes in 1978, which is a 14-inch pipeline. These are multi-product pipelines, so we carry all these products in this pipeline. They are all separated by interfaces. So once the product gets to the pipeline, it comes to up-country storage depots. This is what we call the secondary storage in Nairobi and elsewhere. We have depots for KPC Nairobi and oil marketers. Then we have depots in Nakuru, and then we have KPC depots in Eldoret, and we have a KPC depot in Kisumu. Oil marketers mainly are domiciled in Nairobi. That's where they have maintained their depots, and in Mombasa also. But most of the up-country depots have closed down because there were smaller depots. So once KPC operations in Western Kenya were opened, the unit of operation, the unit cost of operation could not justify oil marketers to continue operating their small depots. So KPC is serving all of them from their main depots in Western Kenya. I've seen some opening up of some depots in Nanyuki. We have 2 depots in Nanyuki, and it's because of the need to serve the Mount Kenya region. And of course, I know KPC was also contemplating on doing some pipelines probably in the future to that region. So from the secondary storage, this product is distributed by vehicles or trucks. And this is what we call the last mile connectivity of some sort for the petroleum industry, whereby from the secondary storage depot to the retail station, we have to use a truck because the pipeline cannot go everywhere. So I'll go to the importation process, which is undertaken through an open tender system, popularly known as the OTS. This OTS has been there for 17 years now, since November 2003. This was done under legal notice 197 of 2003, and this has been revised in 2012 into legal notice number 24. And what basically the OTS did is to consolidate importation of petroleum, the three products I've talked of, so that we could enjoy economies of scale and we could also do better scheduling. Initially, what used to happen is that every company used to bring their ship. Then there would be a queuing system which was not working perfectly. So it became a problem, especially where the priority of who is to offload and who is to wait, of course, that became the biggest question. So what the country would experience is delays in offloading some of the ships, which were critical. Like if you are running low on a product like super petrol and the ship is delayed because of one reason or the other, maybe another ship has overtaken it in the queue, then you would find that the country was experiencing stockouts or a shortage of stocks in the retail stations. So the OTS was brought. We have a scheduling committee that looks at all the awarded OTS tenders and the vessels. Every award has a date range for when that vessel is to arrive in Mombasa. And once that vessel arrives, of course, KPC participates in the planning. Then the jetty will already be scheduled to receive that product. And the tanks, of course, will also have created enough ullage to receive that product. So we are able to increase our efficiency of operations at the jetties. So far, I think you've not experienced shortages in the last like 5 or so years. And it's because of the way this OTS system is working perfectly for this country. So it is centrally coordinated by the Ministry of Petroleum and Mining. And it's a very competitive process. And our neighbors, the United Republic of Tanzania, copied this model sometime, I think 2 or 3 years back. Now they have what is called the bulk procurement system, or the BPS, which is a mirror of the OTS system. So we have procedures, rights, and obligations to all parties, which are articulated in an agreement that is signed by all the importing companies in Kenya. And it's a mandatory requirement that if you become an oil importer, you are licensed. If we license you to be an OMC or an oil importing company, you must be signatory to the OTS. So there's no other route that you can import these products apart from the OTS. So the costs are known and they are controlled. And that is what enables us to be able to do a traceability in our pricing system. So the tender award for each import is based on the lowest submitted freight and premium. Once a tender is called, the bidders who are interested out of the 105 companies, because the tender is floated to the entire industry, whoever feels like they can supply a particular volume of cargo for a particular product, then they are supposed to submit their bid figures on the date of the tender at 2:15 p.m. The tender box is at the Ministry of Petroleum and Mining at Nyayo House. And then that tender box is opened at exactly 2:30 p.m. in presence of the bidders. And then the numbers are read out. The person with the lowest number of freight and premium combined, the freight is the transportation cost from wherever this product will come. The premium is their small return. Of course, they share that premium with the international trader because they don't work in isolation. The international trader is the one who links them to a refinery. For example, in Saudi Aramco, Saudi Arabia, there is an intermediary who now links our oil marketing companies to Saudi Aramco. Or in case they don't have that intermediary, they can go directly to the refinery. So the quote is in US dollars per metric ton. All the other costs are articulated in the OTS agreement. They are benchmarked, they are verified, and they are costs that are compliant to international trading terms. And I'll be showing you some of those costs. So the pricing basis for the free on-board cost. So the product is sold FOB, which is a free on-board cost. There are many Incoterms in that is international commercial terms in the trading of oil. The free on board is one of it. So in this market, product is applied free on board. This is whereby at the point of the product getting into the ship, then the transaction between the refinery and the buyer is sealed at that point, and the risk and title of product changes. So the FOB cost is based on the mean of Platts, and Platts is an international company. It is this company started sometimes in 1909 in New York. And basically what they do is to collect oil trading information across the world, and they're able to do an average of the trading, just like the way shares trading is done. And those numbers are published. And those are the numbers that now traders internationally use to be able to negotiate for their next kind of cargoes in the market. And these numbers, you have to be a subscriber to Platts. They have a platform which traders subscribe to, and which we have also subscribed to as government, and we are able to track those numbers. So a trader cannot lie that the FOB cost was $400 per ton, and when we go to the platform, we find that it was $300 per ton. It's a very traceable system. So the pricing formula is there. So I'll just go into just in summary of how this formula works. So we have the landed cost. It is a cost plus formula. Cost plus means you land the product in Mombasa and then you add incidental costs along the supply chain, the storage costs, the transportation costs, and then now this transportation cost is based on distance. In a cost plus formula, unfortunately, the further you are from the supply point or the landing point, the higher cost you pay. That is what we call a cost plus mechanism. Well, there are other jurisdictions which have explored the aspect of a uniform kind of price across a country, for example, whereby they now look at subsidizing the transportation cost from the landing point. And it is a very intricate process, and to avoid kind of pitfalls where money is diverted, the compensation money is diverted, that process would require a very tight legal framework whereby you maintain a uniform. It's like a unification of the price across the whole country. Whereby if you're in Mandera, for example, and the person in Mombasa will pay the same price as the one in Mandera, but based on the fact that the Mombasa person is nearer the product source, so they'll be subsidizing the person in Mandera. So we have to find ways of now collecting the money which is being subsidized, and then it is refunded to the transporters, because basically it's the transport cost that is being done away with. So the landed cost is an average, weighted average of the imported cargoes for each grade. And basically what we are doing is just summing up the volume of imported refined product times the cost of that, and then divided by the total volume. And that will give you a unit cost of the landed cost per cargo for each grade. So the landed cost per cargo, we also calculate it as per the next formula, where we are doing the FOB, which I was explaining. We add the premium, freight and premium. Then we add the letter of credit. This letter of credit is also an international kind of trading process, whereby since most of these oil companies don't have that trade cash, it requires a lot of money to procure one cargo of petroleum product. So they normally approach a bank, and the bank gives them an LC. So they'll charge, the bank charges them a small fee for that LC. So this has been benchmarked on what happens elsewhere, the charges that occur across the international market. So this cost, the FOB, the freight and premium, and the LC cost, they are usually in US dollars per metric ton. That's why we are multiplying that by a forex exchange rate to convert it to local currency. And then we divide it by a conversion factor, because the density of these products is not like the density of water. The density of water may be 1 kilogram per liter. If you look at the density of diesel, it could be 0.824 kilograms per liter. So there's a conversion factor to convert all that metric ton into a cubic meter, which in turn is also converted to a liter. So once we convert that, then we add the insurance. IWR is the insurance. We have a general insurance for these ships that are coming here. And then there's something that is called the war risk, mostly because of the piracy issues that occur along the corridors that these ships operate. Then we have a KPA wharfage. This is like a parking fee from KPA. KPA has a handbook. This is charged not only for oil cargoes, it is charged even for the dry cargo. Then we have an SC charge. This is a stevedoring cost. A stevedoring cost, when a ship arrives in this country, it docks at the outer port limit in Mombasa. It is a Kenyan pilot who goes to get those ships and then guides them along the channel. And this, of course, is an international practice. In 1989, there was a very bad accident in Alaska, where an ExxonMobil vessel hit a reef when it was leaving one of the ports. And then they spilled a lot of gallons of super petrol, which became an environmental disaster. I think ExxonMobil is still paying for that disaster even today. And it's based on that the marine, the shipping stakeholders agreed that it is only a local pilot who can guide a ship in a particular port. So they are paid a charge called a stevedoring charge for that purpose. Then OL is the ocean loss. These products are volatile. So when they're on the sea, there's some small evaporation that will occur. So if you loaded 10 million liters, that ship may not arrive here with 10 million liters. So we cater for that. Then the A is the administration cost for the OTS process. And this is basically to the person who won the OTS. They are given a small cost, a small compensation because of the invoicing process, because of the bank charge process, because all these monies will be transferred through banks. Then the I is the inspection. This is a standard practice. When the vessel arrives in Mombasa, there must be inspection of the vessel, the cargo on board, and a report is given. This is just standard marine processes. And then AR is the analysis and recertification of the product. This is to ensure the product meets the Kenyan standards. And the D is the demurrage cost. This demurrage cost is not a standard cost. It may be there or it may not be there. This is the cost we pay for delaying a ship. When, for example, our jetty is not available for one reason or the other, if there's an emergency, for example, and a ship arrived on time, normally when these ships arrive, they tender what is called an NOR, a notice of readiness. It tells you that I've arrived, it is a need of sea passage. We are at Mombasa. We are at the outer port limit, so send your pilot to come and get us. So in case the jetty is not available after the notice of readiness, so you'll only be given 6 hours. Then they will give you another 48 hours, which you're supposed to utilize. They have calculated the 48 hours to be the time you should have taken to discharge that ship. And then after that, now demurrage starts counting. They start counting. This is the opportunity cost of that ship being in Mombasa rather than being elsewhere doing business. So once we get the landed cost, then we calculate the weighted average landed cost. Then we move to the next step of calculating the wholesale price, which is just the landed cost. We add the jetty handling costs. At the jetty, there are small costs. And then the CP is a primary storage facility cost. So once the products are stored like at Kipevu storage facility, there's a cost to that. And then based on the volatility of these products, there's also a small loss factor. That is what we call LPS. This is a primary storage loss. And then we have now the pipeline tariff. The PT is a pipeline tariff. When this product enters a pipeline to Nairobi, the beauty is prior to 2018, 80% of the products were coming through pipeline and 20% were coming by road, apart from Jet A1, of course, for obvious reasons, because of sensitivity of the product. So for super petrol and diesel, 80% was coming through the pipeline and 20% was coming through road. The road is a bit expensive it's almost double the cost of the pipeline. So that's why I'm saying we are lucky, because after 2018, everything 100% now comes to the pipeline, and we are able to save that 20% road factor. So the LPT, this is a pipeline loss. This is a standard because of handling these products, volatility issues. We are using the actual pipeline loss. The benchmark, the international standard benchmark is 0.25% loss, but the actual loss, like for example, last month was 0.07%. Then we have the secondary storage, the upcountry depots. These are storage costs, especially for oil marketing companies. When the product moves from Nairobi, PS10, for example, the KPC depot in Nairobi, it is piped to an oil marketing depot storage there. So there are depot maintenance costs, there are staff they have in those depots. So all this has been priced, and we got a throughput tariff, which now we call a secondary storage cost. Then, of course, there's a loss factor for that secondary storage. And in 2018, we did a cost of service study for the supply of petroleum products in Kenya. And it was found that there's a financing cost that is incurred in the process of buying these petroleum products by the oil marketing companies. And that cost was not being compensated. So that is why we have a CF there, which is a financing cost. And this cost comprises of two things. It comprises of the financing cost for the product, and of course the secondary storage charge for the oil marketing companies. Then we have the margin for wholesalers, that's MW. Then we have the taxes, and then we have the VAT. This is the value added tax, which came into place in 2018. The pump price, how we get it is we take the wholesale price, we add the TS is the local distribution. Remember the track I was talking about, the last mile. So because the pipeline cannot go everywhere, so we normally add a small distribution charge. That is like getting your product from the depots in Nairobi and bringing it to a station somewhere like in Bellevue. So that is the TS. But this TS should be based on the nearest wholesale depot. So if Nairobi is nearer you, if you get the product from Mombasa, we'll only compensate you for the distance from the nearest depot. So the MRI and the MRO, this again came from the cost of service study. The MRI is the margin it's a retail investment margin. This is for investing in infrastructure, like the retail stations. The cost of service study found that doing as one station, a standard station that has met all the standards, will actually cost you like 80 million Kenya shillings, excluding land. That is the normal Total or Vivo Shell station that you see. It is quite expensive to build. So there was reason to compensate the investors who have put their money in that infrastructure. And then the retail operation margin is now for the dealer who is operating the station. They are compensated now for the utilities, and they are given a small return. The utilities, they have water, electricity. They also have staff in these stations. They do a lot of safety issues. So all that was looked at during the cost of service study, and it was validated. And then we have the VAT again. So going to the pump price for April. So this is a breakdown. The landed costs have been put there. So the landed cost was for super was 53.99, diesel is 48.95, and kerosene was 46.23. Then we have the pipeline transport. What I told you, it's 100% now. So per liter, we are getting 2.16 for across all products. This tariff is approved by our board. So Kenya Pipeline has to apply for a pipeline tariff, which is taken through a rigorous process, including stakeholder process, whereby we go out to the counties and to other relevant stakeholders. Counties is where we are covering, for example, the normal mwananchi who may have an interest in in the tariff process, because they are consumers. They end up paying this cost through the pump price. So we normally involve Mwananchi also through the lobby groups, or we go to parts of the country and we're able to get their views. We publish what Kenya Pipeline has applied for as a tariff, what they think could be their returns, and then we get views from the stakeholders before our board makes a decision. So the road transport is zero. As I said before, pipeline loss is 0.07%. The benchmark is 0.25%. You see, it's about 8 cents per liter or thereabout. Depot losses, these are international benchmarks, 0.5% for PMS, which is, PMS is a super petrol, 0.3% for kerosene and diesel. And you can see those depot losses is about 50 cents, 26 cents, 24 cents. Then delivery within the 40 kilometers, this is the last mile, which I was talking of. So we have marked that every 40 kilometers becomes a different pricing region. But within the 40 kilometers radius now, the distribution cost is the same. So the distribution cost there is about 54 cents across all products. Now the storage and distribution charge, now that is addition of the transportation plus the storage and the last mile, now becomes like 3 shillings 29 cents for super, 3 shillings and 3 cents for diesel, and 3 shillings for kerosene. So we have oil marketing company margins. We have put 7.95 there, 10.08 and 8.89. The reason we've done that is that you are aware that it is a stabilization process that is going to happen because of this pricing. Government decided to hold the prices, the current prices constant. That's why that margin has gone down. So oil marketing companies will be compensated for the balance of margin. The normal margin for super petrol, as per the cost of service study and as our previous calculations, should be 12 shillings and 39 cents. And that 12 shillings and 39 cents comprises, like for super petrol, is 4 shillings and 20 cents wholesale margin. And then it has a retail investment margin of 4 shillings and 5 cents and a retail operating margin of 4 shillings and 14 cents. And these are costs that have been verified. Total margin for AGU is AGU is diesel is 12 shillings and 36 cents, and kerosene is 12 shillings and 36 cents. So these are costs that were subjected also to stakeholder process, and we have verified that the actual cost along the supply chain. So the other bigger component now is the issue of taxes, and you can see how we have tabulated those taxes. We have excise duty, 21 shillings 95 cents for super petrol. RML is the road maintenance levy, is 18 shillings. Petroleum development levy is 5 shillings and 40 cents. Petroleum regulatory levy, this is what funds our operations. As per the act, we don't get our monies from the exchequer. To fund the regulators' operations, we only get 25 cents per liter. Then the railway development levy, this goes to funding the SGR, this 1 shilling and 4 cents. The anti-adulteration levy was put on kerosene. You can see the other two products don't have 18 shillings. This was to cater for, to discourage people from undertaking adulteration. The difference between kerosene and diesel prior to September 2018 was 18 to 20 shillings. So what people used to do is to get a liter of kerosene, put it in diesel. That liter of kerosene gains 18 shillings. And I may shock you that once this process was done, the consumption of kerosene in this country dropped from 41 million liters per month to about 12 million liters per month. That is a difference of 28 million liters per month, which was going into our engines as adulteration product, and which government was losing revenue of 18 shillings. So you can calculate that per year and you find it's almost 7 billion shillings. So there was reason why that was put. And the moment that 18 shillings was put, then the demand for kerosene disappeared. Before we put that, we had done a paper to the National Assembly and of course to the policymakers. And we had also benchmarked with the United Republic of Tanzania. They have also increased taxes on kerosene in the past few years. Their consumption was normally about 30 million liters, and it dropped to about 5 million liters. You can see they also lost 25 million liters, which was also going to our people's engines, and people evading tax on it. The merchant shipping levy goes to Kenya Maritime Authority, so that was done through legal notice. The IDF, this is a standard fee that has been there. It's a percentage, it's about 3.5% of CIF. The road maintenance levy is 2% of CIF, and this comes through the finance bill. And then the value added tax, and that gives us our total tax for PMS. Super petrol is 57.58. Diesel is 45 shillings and 60 cents, and kerosene is 39 shillings and 73 cents. So that gives you the final price of the pump at 122.81, 107.66, and 97.85. So this is just to show you the progression of these pump prices from 2019 March. We've done it for a period of 1 year. We have data from 2010, and it just shows you the movement of how the prices have been moving. This yellow part is the landed cost. And you can see sometimes in May last year and April, because of COVID, it dropped drastically. This is the time the crude oil had gone to $17 per barrel. And then, of course, after the economy started opening up, you can see the recovery. Today, the crude is, as of last month, the crude had climbed to about $65 per barrel. So we've come from $17 per barrel up to $6. So you can see the raw product, the raw material for the products that we consume has gone up. So definitely our imported costs will also have gone up. So the taxes are constant, they are almost constant, but they have been increasing depending on the government policy. Like you can see the shifts here, these are the VAT. And then between June and July, you can see now the cost of the taxes have changed for some time, but have remained relatively constant after that. So the I don't know whether it's a brown one. These are the margins that I was talking about. And then demurrage costs is very small. We do track this demurrage cost for efficiency purposes. So it indicates to us whether our system is, whether the planning is being done correctly. And it makes us now prompt the policy maker, the ministry, and we advise them to take measures if we find that the demurrage cost is increasing quite a bit. But I can confidently say that over the years, we have quite worked well on that demurrage cost. So the gray one is a distribution cost, and you can see it is also fairly constant. The same is for diesel, and you can see it's the same trend. These products also almost follow the same trend. I'll not go into that. And then this is a kerosene one, and you can see how kerosene has dropped and again started going up as the barrel went up. So we also trend the movement of prices in the international market vis-a-vis the pump price. What you see below there, like the blue line now, there are two blue lines. One is on top. The one on top is the kerosene price, international price. This is the one for super petrol, which is somewhere superimposed in between. Then there's a black one, which is a crude oil, and there's a gray one, which is a diesel. These are the, these are the international prices of petroleum products as we buy them from the international market. And you can see above there, these are now the movements of the local pump price. You can see the pattern, it mirrors the international price. The difference now is because of the incremental additional cost we have in terms of tax, in terms of distribution costs. So that is just to show you that we do track and make sure that whatever we are selling here also mirrors what is going on in the international market, despite there being a lag period of about 30 to 45 days from the time we import this product. We order to the time the product lands in Mombasa. And that's it. I hope I've been clear.
Thanks, Engineer, for that very elaborate presentation. And yes, you have been very clear, but I know there's going to be a lot of questions, especially on the formula and the contents thereof. As we could see, there are a lot of metrics that are being used and considerations, which include margin for retailer, the wholesaler, some losses that are being incurred in the transportation overseas of the oil, inspection of the vessel, and such like terms. But just by way of summary, just Engineer Kinyo has given us the lowdown on the formula, which was actually the main theme for this particular webinar. And he has given us a background of where EPRA comes from, the formation, and they took over from the now defunct ERC. They have an amendment to the Act of 2020 in 2012. And also that what we need to consider is that we don't, in as much as we had some excavation of oil in the past few years, we had to realize the benefits of that drilling. So we still import oil through the open tender system, which is open to importers who must be signatory to the open tender system. And he has also told us that there's about 105 companies that are involved in this, but the one being chosen in an open tender system is that will give the lowest bid in that particular system. We also note that there's need to ensure that the benefit comes to the consumer, such that the one who is in Mombasa does not get much more of a benefit than as opposed to the one in so to speak, Mandera. So the costs are somehow they try to standardize the costs such that the benefit comes to all consumers. So without much further ado, I want to welcome our CEO, Kwame Wino, who will take us through the plenary session. Kwame?
All right. Thank you, Steve. Let me just start by thanking Edward Kinyo again for, I think, an illuminating presentation, and thanks for creating the distinctions between the different products, breaking down the formula, and obviously, I think we come out more educated than many people are. This formula is explained. Of course, I know some of that data is available on the EPRA's website. But I mean, when you have somebody who knows it and understands the facility, then the explanation that you give has been especially educational for me. So I come out certainly at a minimum, I'm more aware and all that. But ladies and gentlemen, I know there are some of us who are listening, so two things you could do. I'll open up in a couple of minutes an opportunity for you to ask questions directly to Mr. Kinyo. But before we do that, I'd also like you to know that there's a chat box somewhere on the top of the menu, floating bar. And one of the things you could do is if you have other questions, you could send them in. And if people vote in for those questions, then I'll ask the questions that many more people have voted first. But you could also just raise your hand when I open up these chats. But let me ask Mr. Kinyo 2 questions as you all set up. One of those is that, I mean, because I'm a little older, I was at the IEA when this debate started about bringing in the formula, or rather the debate that culminated with this formula. And we need to say that at the Institute of Economic Affairs, our standard economics textbook and the price theory tells us that markets that are open, competitive, and transparent are better than mechanisms such as this. So we understand that the reason that we had to have a formula of this kind and to have the technical regulation and price setting, because this formula is a price setting formula. I don't blame the EPR. I don't blame the authority for it, but I think an economist should say it as it is, which is basically it's a mechanism for managing price. You're also right that it's not only Kenya that uses this. I think India has a similar or something that's proximate to this, and obviously that other people are taking it shows that there's something about this global product called oil or energy that incites or generates the kind of pricing pressures that then makes governments come in to try to manage consumer interests, or the interests of the consumers, whether to stabilize supply, to ensure that the product quality is good, and obviously pricing as well. But you've also mentioned the open tender system. And the open tender system is actually a little extreme from what a marketing mechanism would be. I mean, a competitive price would be. There are 105 people who participate. I think because of the nature of the oil product, many of those people who actually have an opportunity to win the tender would have to be the bigger farms or coalitions among those bigger farms. I don't think the smallest trader in Kenya maybe has a chance. So while there are 105, my guess is perhaps maybe 10 or 20 people at the most are actually capable of winning that tender and actually bringing in that oil. But if I am wrong, please correct me on that. My bigger question, however, is you mentioned that when the price is opened, or rather when the tender is floated, I think on every month, you say that at 8:15, or is it 2:15 in the afternoon, the tender box closes, and at 2:30 it is open, which is nice because that gives the impression of obviously competition and all that. But I suspect that there might be some collusion, because the reason the prices came in, the price control mechanism, price management mechanism came in, was because there was suspicion of collusion among firms. It wasn't proven, but there was a strong suspicion of collusion among firms. How sure are we that under the present system, there's no possibility for collusion? So that's the one question, because that's an administrative question. Obviously, it's not the EPRA that manages that, it's the Ministry of Energy. But let me ask that and how public interest is covered. But the second point that I have is about the pricing formula is, it's a good thing that the tender is opened in the presence of all the members of, the participating, competing firms. Is there anybody who covers the public interest on the consumer side? So for instance, if we at the Institute of Economic Affairs were to offer to examine the tender process as it's being opened, would we be allowed? I think that system is very closed, and that transparency problem is also one that that bothers me quite a bit. I'll ask a few questions later about the stabilizing margin if nobody else asks. Stabilizing mechanism if nobody else asks. But in the meantime, just those two questions. I would be glad if you can answer those. Then we can open up to the rest of the audience.
Thank you, Bwana CEO, Bwana Kwame. I got your questions very well. And one, I think you asking about the spectrum of people who win the tenders. Out of this 105, for example, I need first to tell you that less than 10 companies are multinationals. And these tender documents, the tender winners, and of course the volumes they have brought is also public documents, which we have also shared with Parliament at their request. And you can see for the last 2 or 3 months, these actually even for the last 6 months, the multinationals have not won these tenders. These tenders have been won by Kenyan companies. Kenyan companies, most of them, you find 2 or 3 companies which have actually established themselves in Kenya for the last 10 or so years. They have understood the trade and they're able now to win tenders and even defeat those multinationals, which is a very good thing for us. It's local content. And of course, even the big multinationals are feeling run for their money. In terms of collusion, I can assure you that the process is transparent, and in case you would want to witness a tender opening, you would just need to get in touch with the PS Petroleum, since he's the one who represents the government in the tender process, and he also witnesses the opening of that tender. He's the administrator. Actually, he's the one who announces the winner and gives the winner a letter to indicate that you have won a bid, and then you are given a date range. Your ship should arrive in this country at this period. Normally, we plan 1 month in advance just to ensure that we have security of products. So in case any member of public would want to witness the tender opening process and evaluation, they can always get in touch with the PS because he's the administrator, and they'll be allowed to be able to witness how the numbers are done. We also work very closely with the Communication Authority, the Competition Authority of Kenya, CAK, Competition Authority of Kenya, and actually they also oversight this process. in case they suspect there's any collusion, and then they are able to do some very detailed investigations. And if they find that any of the marketers discuss pricing among themselves, then the consequences are dire, which may include our revocation of their license. So it is a very, very sensitive process. I am not sure that marketers would risk discussing these prices. Thank you.
Right. I mean, thanks a lot. Thanks a lot, Mr. Kinyo. Now, I'll open up the conversation to questions or even comments. Please, if you have any questions or comments, I'll advise that you switch on your camera and you unmute yourself. Ask the question, state your name, ask the question, and then I'll take 3 questions at a time and ask Mr. Kinyo to answer them, and then we'll come up for a second run the track. Anyone with questions? Please remind me if I don't see any, but let me try and see if there's any question on the. Okay, there's a Mr. Wanguhu who's asking, does the lack of a KPC depot in Nairobi have an impact on the price in Nairobi? And then could we get a breakdown of the other towns? I hope that's it. Mr. Wanguhu is asking, does the lack of a KPC, I think the Kenya Pipeline Corporation depot in Nairobi, have an impact on the price in Nairobi? Could we get a broken down? I thought there's a depot in Nairobi, but you could answer that. Okay, that's one question. The second is, well, that's the only question. So maybe, Edward, could you respond to that?
Sorry, Kwame. There's a couple of as well.
Oh, really? Is there another one? I've only seen the one by. Okay. Yes.
That's the last one. Yeah.
Okay, fine. Yes, there is. Then there's John. John is asking, can we see any significant reduction in the road maintenance levy since we have moved the main transportation to the pipeline? Okay, that's another question. That's a question from John. Can we see any significant reduction in the road maintenance levy? About the road maintenance levy since we have moved the main transportation to the pipeline. Okay, that's one. And then the second is Immaculate Moranga. And the question says, first, he thanks you for an informative presentation. I agree. Now, how fair is it that the consumer is paying a higher amount in tax and levies more than the landed costs? Okay, I don't think that is Mr. Kinyo's responsibility. That's the responsibility of Parliament, but let's see what he has to say. And how is EPRA cushioning the consumer as a petroleum regulatory authority? Okay, the second question, yes. So, Edward, you could respond to how is EPRA cushioning the consumer, and whether you have any view about the taxes that come up. I mean that are loaded on the petroleum product when that the consumer pays. And then Mr. Wanguhu's question. So let me come back to you, Edward. Please go ahead.
Thank you, Bwana CEO. Yeah, I'll start with the question of Mr. Wanguhu. He's asking whether the lack of a KPC depot in Nairobi impacts the price. But we have a KPC depot, as you rightly stated, Bwana CEO. Maybe what he's looking at is the aspect of a logistics facility where they can be able to load. You realize that the KPC depots in Western Kenya, that is Nakuru, Eldoret, and Kisumu, they have loading facilities. The one in Nairobi is just a transit point for this fuel. It doesn't have loading facilities, and products have to be moved from that depot to the oil marketing depots, secondary storage, for them to be loaded. And this is a product that is being utilized maybe in Nairobi and its environs. Yes, it has an impact because once the product goes to the secondary storage, there's a secondary storage charge, which of course could have been avoided if KPC itself had a storage, had a logistics facility within its Nairobi depot. However, these are the issues that we are discussing with KPC on aspects of improving efficiency along the supply chain. And that is why it is sometimes good to break down this price into nodes so that you can see where the inefficiency or where we can save on a cost. So as I rightly said before, you remember our capacity for line 1, which is the old line from Mombasa to Nairobi. When it was constrained, we were also losing some money to the 20% to road transportation. So once this was brought to the attention of the policymaker and KPC, that's when now they decided to look at ways of now building a new line, bearing into fact even the other line had gone beyond its life. And it gave them more impetus to build a new line, which we have now, which has saved us that cost. So yes, I agree. There's something that we need to keep on deliberating about with the policymaker and both with KPC. But I know, yeah, it is something in the pipeline. I may not try to divulge some details, maybe only KPC, because they are the ones who are in control of those details. There may be plans for them to acquire the National Oil Depot in Nairobi and use it as a logistics point. That is still at preliminary stage. So that may save that cost. In terms of John, who was asking whether the significant reduction in whether our reduction in the use of pipeline can translate to RML. RML is charged to the road users, people who are using the roads, and this is a maintenance cost for the old roads and also for building new roads that government has put. Remember, initially we used to have toll stations along some major highways, some classes of roads. So when those toll stations were removed, this was consolidated into a road maintenance levy fund. I think that act happened, it was done in 1993, and we've been paying our road maintenance since then. So the aspect of reducing or increasing now, that is a policy, it's under the purview of the policy makers. And I'll answer that question together with a question that was asked about why we are paying more taxes than the landed cost. Basically, that's also a policy question as we just implement. And once policy has made a decision, a law or a legal notice is made, once the legal notice is passed to us, then we just implement the legal notice as it is. In terms of consumer protection, I think we have done quite a lot in improving efficiency along the supply chain. Sometimes back before this pricing came into effect, you would hear ships were staying in Mombasa even for more than 4 weeks. Queuing in Mombasa. If a ship queues in Mombasa for 4 weeks, you can calculate the amount of demurrage they can pay if they are paying a demurrage of like 2.5 million shillings per day. So you can imagine the amount of money that would go to the consumer, and all these were passed through costs to the consumer. So as by bringing on board our third eye is to make sure that once we look at a situation that a ship has stayed in Mombasa for 5 days or 10 days, then if that period is a period that is beyond the metrics that we have set, then we will tell the person who imported the product, no, the consumer cannot pay this cost. We will just compensate you for the benchmark we have set or the KPI, the rest you bear it. So it's the same thing with the pipeline. When pipeline is operating, initially they used to charge to pass the losses, the pipeline losses at the international benchmark of 0.25%. Then we came in and asked them, why would you charge at 0.25%? Could you tell us what was the actual loss? Because the 0.25% is the maximum. So that is how we reduced it to 0.07%. So these are small things that we keep on checking and making sure that the consumer is protected and that these unnecessary costs don't come up to the consumer. Maybe that's what I can say for now.
Okay. Okay, thanks a lot. So there are two, we'll take a second shift of questions. So here we have a question from Fiona, and I think it's something you've already answered it. She asks, in terms of the ocean loss, is there a specific margin that the loss shouldn't exceed, such as, well, she gives examples of a 10 or 20 or 10% or 2% of the total amount that is being imported. So basically, it's just asking, how do you place a threshold? I think it's part of some of the stuff you've said, but maybe you can clarify that again. And the second question is from Shelmith Mugo, asking, it seems, this is also a policy question, I think. It seems the items constituting the largest proportion of petroleum and diesel, petroleum, I think they mean premium petrol, and diesel prices are excess duty, road maintenance levy, and VAT. Why then add VAT to the formula? Isn't that double taxation? Okay, I don't get that clearly, but basically she says, I mean, it says, the questioner says, it seems the items constituting the largest proportion of petroleum petrol, I think they mean premium petrol and diesel prices are excise duty, road maintenance levy, and VAT. Why then add VAT to the formula? Isn't that double taxation? So that's the second. And then I'd like to ask my own question before we come to, okay, there's been another question from Shelmith as well, saying, how comes diesel and petrol prices, I think premium petrol prices in Uganda is relatively cheaper than that in Kenya, yet it passes through Kenya? Is it a policy issue, or especially on taxes? I think she's part, I mean, it's part answered the question, but Kenya, you could give us your responses to those two.
Thank you, Bwana CEO. Ocean loss it has a KPI, a key performance indicator, which is internationally benchmarked and which even the cost of service study was able to validate. So there's a cap for that, and if you bust that cap, then you bear the other cost. So it is something that we also watch very closely. In terms of the taxes, the excise duty, road maintenance levy, as you have rightly said, CEO, I think these are policy issues. We are just an implementing agency, so that is a question that may be directed to policy makers like the National Treasury, and as we just implement when it comes out. And that also touches on VAT. VAT is also a policy issue. You know, there's a VAT Act 2013, which had deferred VAT on petroleum products from 2013 to sometimes in 2018. And then when that period expired and of course the law came into effect, we had to put it, because when we are computing these prices, we have to make sure that we are compliant with all laws. Otherwise, even us will be sued. Diesel prices in Uganda and petrol prices. First, Uganda is not price regulated. It's a free market. Number two, also the tax regimes are different. So you find that the tax in Uganda might be lower than what we have here in Kenya. So definitely that will bring a price difference. But looking at the prices which you can get from globalprices.com, this is an international so kind of a tracking website which tracks diesel and petrol prices across all countries in the world. I think you'll see, like, as of today, as we speak, Ugandan prices of super petrol are higher than ours. So despite them having a lower tax because of the distance of transportation, they are bringing this product from through Kenya. So then they are adding the landed cost and putting the transportation cost across the country to Uganda. Then that has caused their prices to go a bit higher than ours. But you'll find that they also do probably some close subsidization. You find in some areas the marketers there are selling very high. In some premium areas, it's like you having a station closer to Runda here or probably Karen, because of the purchasing power. The people who live there, the prices will be much higher than the prices you'll post in other places. Like now places like Kayole. So it depends on the stations, and that's why we are saying you must look at an average so that you don't find some guys in some areas are getting lower prices, but when you go to some upmarket areas, you find the prices are very exorbitant. So they try to do some balancing. That's what I would say. Thank you.
All right. Okay. I haven't seen any other questions, so let me come up with my final question, and then perhaps you can make some closing remarks. So the one question, yes?
Can I ask a question before you go?
Yeah, go ahead.
Nice.
You have an echo. You have an echo on. Go ahead.
Okay. I understand that this formula is supposed to make the fuel price predictable, either for the consumer or also guys maybe who own the petrol stations. But I'm just wondering, is there like a cap that the formula probably has in terms of prices, so that we can say that it shouldn't go beyond price X so that we can be able to protect consumers. That wasn't clear for me during the presentation. So probably, engineer, you can touch on that.
All right, thanks, Fiona. As he touches on that as well, I wanted to look at the, I'd like to ask this question as well, so that Edward Kinyo can respond to. One of the things that was expected at the end of, in mid-April, was that the prices would rise again, but this obviously did not happen. And I think I've seen incoherence, but what we hear is that government decided to institute a stabilization mechanism, and therefore prevented consumers from actually having to pay for what a transparent price mechanism should do, suggesting to me that there must have been some policy or political decision made to try and make it look like the prices did not rise. So I'd like you to elaborate, to explain to us, at least educators, on how exactly is this price stabilization working? Because the fund is something that has been spoken about, but I don't know whether there are proper regulations and rules that have been made to bring it to the fore. And what's the extent? I don't think there's sufficient money to stabilize it, but I also think that there's a contradiction. If the intention of the pricing mechanism, again, this is a policy question, so obviously you can give it a pass, but if the intention of the pricing mechanism instituted years ago was to ensure that prices were kept below a certain amount, or rather were kept stable or prevent price gouging by the marketers, is interstabilization mechanism just another game where the price consumers pay, but they're given the impression that prices are lower, but basically the consumers, the marketers are being given a payment to ensure that they don't increase their pump prices, but really the price of the product is actually, it's an illusion by giving us the impression that prices did not rise, but consumers are paying because the levies that you've paid earlier are now being used to subsidize the cost for the consumer, for the traders. And one thing that I've also, this perhaps you can comment upon, because you said that the prices were, a cost study was done, that was very detailed, and that it determined some of the margins that we have. I'm just wondering why, and this I say as a peer student of economics, why should the government of Kenya be interested in ensuring that people who trade petroleum do not make losses, so that you're guaranteeing them the price, a profit of 7 shillings per litre on premium petrol, when somebody else who's selling, say, food, which is an equally important product, never has that assurance? What is this? What makes the energy prices, the energy industry, petroleum energy industry, so special that you're saying that if you're a dealer, we will always ensure that you sell and you have a profit margin, so that basically they do not have to do anything else provided they stay within that profit margin? I found that a very curious way of designing markets, because it has its own unintended effects. One of those is that nobody is under pressure to actually reduce costs beyond that, to sell more by going cheaper. But you could explain to us what the logic was behind this, and how you determine that somebody should be able to make 7 shillings per litre regardless of how else they conduct their business.
Thank you, Bwana CEO. Those are heavy questions, but I'll try to answer them as best as I can. Well, these are two aspects that on this question on the predictable price, the cap of the cap price. So I earlier on mentioned about a stabilization process, and then there are some countries which also have an equalization mechanism. These two mechanisms were explored by the cost of service study in the supply of petroleum products. And well, they said it all depends on policy. If policy wants to implement them, there can be put in place mechanisms to control like how the process will work. So the stabilization is where we are setting a ceiling price, so that anything above that ceiling price, the consumer does not pay for it. So the pump price will be maintained at that ceiling. And of course, when the prices drop, below the ceiling, the consumer now will start paying, will just pay the ceiling, but that money now goes into a kitty whereby later on it will protect when the converse happens. The equalization is where we have the same price across the country, and of course we have that cross subsidization of our transportation cost, and we are able to compensate the transporters. So I know the government through the National Treasury and the Ministry of Petroleum and Mining, for the April prices, they have commenced a process of stabilization. And as you said, this is a policy issue. We may not comment much on it because we are just implementing. How the process works now is a domicile at the two ministries. And I believe they have put in mechanisms to ensure that the process is successful. The other one, in terms of margins, why we are guaranteeing a return, these are not actually net margins. These are gross margins. If you look at the returns to these companies, when they actually net off their expenses, the cost of doing business, sometimes they get very little money out of these margins. In fact, the cost of service study had articulately indicated that these margins need to be reviewed on an annual basis based on the CPI, the Consumer Price Index of goods and services in the country, which we've not been doing. For example, you look at 2010 when we came in to undertake capping of prices of petroleum products. I think we stayed from 2010 up to 2014 without looking at the margin at all. And of course, during that time, the minimum wage had changed. Bank interest rates had changed. A lot of things had changed. So these guys also take a hit on those changes in market dynamics. And that's why the cost of service study had to put a definite period within which certain variables like these margins need to be looked at. I know they said annually. This cost of service study was implemented in 2018. And I can tell you, we've been resisting a review of these margins because of the economic situation in the country, and also because of the cost of product, like now the way the product is going up and the pandemic we have. So you can see marketers have been putting pressure on us. There are a lot of communication they have written to us, but looking at the status, the economic status of the country, we decided not to review the margin. This was not the right time to review those margins. So I can tell you these are gross margins, and it's not that this is what they put in the pocket. Thank you.
Thanks a lot. I haven't seen any other questions, so I'll just have to pass this to my colleague Fiona to give the final comments and the vote of thanks, and so close the meeting. Thank you very much, Edward Kinyua. We are glad that you are able to make this presentation and have been available to give us some very solid answers. Fiona, I pass this to you. Thank you.
Okay, thank you, Kwame. On behalf of the IEA and all the attendants, attendees, I would like to thank you, Engineer Edward Kinyua, for that fantastic presentation on the petroleum pump pricing framework in Kenya. So we really appreciate how you have broken down this area and classified various aspects of it. So thank you so much. It was useful, and I know I speak on behalf of everyone. So just as a follow-up, the program, which is the Economic Competition and Regulation Program, will do a brief on this webinar, and we'll post it on our website. So yeah, you can look at it later. It will be uploaded. Yes, and you can also follow some of our pages. That's Twitter and the website. Thank you. Bye.
Thank you. Bye.